Good morning, everyone, and welcome to the Ankerstar Wealth Morning Show. I'm your host, Allison Ankerstar, and today we'll be talking about the worst stock market day of 2023, 5.5% CDs, and the four possible outcomes for 2023. But before we begin, as a reminder, this is a financial education presentation and should not be construed as personal financial advice. Full disclaimer information is available at ankerstarwealth.com. Good morning, Steve. The markets are in the green for this morning after yesterday being the worst market day of 2023. What's next for the market?
Yesterday was a little bit brutal, heavy in the red across the board. When today's February 2nd, 2022, that's a lot of twos today, so kind of a cool day numerically. But we're seeing the market in the green right now. Let me refresh this real quick. We're right after the market open, about 20 minutes into the day. So futures have been in the green. What's the difference today? Well, first of all, when you come off a terrible day, you tend to do better than, there tends to be a bounce anyway. But when you look at, what's going on out there, is we do get the Fed minutes today. So here's kind of the article that's on CNBC this morning. The numbers from yesterday, all pretty bad. I was looking for the, NASDAQ down 2.5%, Dow 2%, S&P 2%. Dow actually went negative for the year. The NASDAQ still well into the green though. So what do we have today? We have the meeting minutes. So if a reminder for the cycle, you have a Fed meeting every 6 weeks where they announce at the end of it, there's the announcement, and then they either move rates or they don't, right? Well, they don't publish the minutes that day. They only publish that one statement. The minutes are actually published the 3 weeks later, right? So 3 weeks out of cycle, you get the minutes to digest. So really, you're getting something from the Fed every 3 weeks in the financial world. So again, anxiously awaiting to see what those Fed minutes say. However, some things have changed since then, right? Like we've gotten two bad inflation numbers that now the expectation is that there's going to be another 25 basis point rate hike in 3 weeks, and then another one 9 weeks from now. There's some talk out there about going back to the 50 basis point raise. I do not see that happening, but 25 and then pause is what the current projection is for the markets out there. So we'll have to stay tuned, but overall, I don't think we're going back to the lows of last year. I think yesterday was kind of that oh crap day where everybody got negative. I think once we see the minutes, I think that will help us go a little bit higher back in the market today.
Next, CDs are now paying 5.1%, and some expect them to get all the way up to 5.5%. Should people wait to buy them?
Yeah, well, we talked about this a little bit, several days, a couple days last week and then yesterday. Money that's piling in right now, I'm putting into CDs. You can do as low as 3 months, out to about 18 months. I'm not really going out past that unless somebody's specifically requesting it. But yeah, you can capture, 5.5%, 5.1% right now. Now, this 5.5 comment that Morgan Stanley put out said, well, if we do raise rates per projection, in 2 months from now, you can get a 5.5% CD. So the question was, buy now, buy later. Well, if you wait, you're earning zero, right? Or whatever your bank is paying. So you have to factor in, if I, sit and do nothing for 2 months, I'm missing out on the 5.1% interest I can get now, waiting for the 5.5%. And you're like, well, if you run all the math, what would be the best? Well, if there were no other factors, then yeah, you should probably wait. Even, get zero for now and then wait for that 5.5. But here's the problem with that math is if you wait and the rate never gets, the boat that never comes in, right? So if you wait and it doesn't ever hit 5.5%, then what do you do? Right? Because this is a projection. It's the same way when you go to buy stocks. It's like, okay, well, the stock market's going down. I'm going to wait. I'm going to wait. I'm going to wait. I'm going to wait. I'm going to wait until I hit my own price target, and then it reverses before hitting that price target, and then you end up not having the stock. Right? So same sort of mentality of you don't really want to get into a wait forever game. If you have, say, 100,000 on the sideline, I'd put 75,000 of it to work now, and then maybe wait with the other 25,000. So if that's one way to manage it. Or what I do personally with my money is when it frees up, I take it and I put it at the best thing I can get at the time, because there's always more money that's kind of being freed up from different investments and things. So I wouldn't wait and try to get too fancy. But if you absolutely have to have the the highest 5.5%, because 5.1 is not good enough, then you can wait it out. But then that same person's also going to be mad when it actually goes to 5.6%, and they're like, "Oh my gosh, I could have waited another, whatever to get 5.6%." But such as investing, sometimes good enough. Get your money, start working for you, and then just every time you have more money to put to work, you look for the best thing at the time. So my philosophy there.
Last, what are some possible economic outcomes for when the Fed finally stops raising interest rates?
Well, Ed Yardini put this out yesterday. Was an interview, and then this article summarizes it. Four possible outcomes. So from military planning, you learn that you have five possible outcomes, right? There's the really, really good outcome, which is like the perfect world, which really never happens. And then the bottom one is the end of the world outcome, which generally doesn't happen. So then there's the pretty good, expected, and then bad, slightly bad outcome. Really, you plan around those. Well, he's putting out four outcomes here. The first one, with a 40% probability, is he's saying things are actually pretty good for the U.S. That 40% chance that we still have the soft landing, even if there's a couple more rate hikes, because the economy is so strong and because we have full employment. Now you saw with the retail earnings coming in, the earnings, for Home Depot were bad, but Walmart was good, but both projected down, right, for the future. So if everybody starts projecting down, we could actually kind of induce this recession that we're so worried about, because everybody keeps saying there is one. Well, we can like manifest one. But through stopping spending and being overly cautious going into it is what I meant by that, not just like the physical manifestation of the words, but by preparing for it, we might actually cause it. Interesting. We shall see. But 40% chance of the soft landing, where the inflation goes down to 3 to 4%, and interest rates basically hold where we are. He said that's the best case. The other ones is disinflationary, no landing to 20%. The hard landing, and then inflationary no landing, which would really be the worst one, is that so you have the most likely is the soft landing still intact, 40%. The worst case is that 20% is we still have inflation a year from now, and we can't stop raising rates, right? So that's kind of the worst case scenario. But to summarize, so the most likely is still only 40% in his eyes. So there's still 60% chance of some other thing happening than what we expect. So how do you play that with the market? Well, I think you do have to lean towards the most likely that we are engineering a soft landing, and then stay invested. If you think the other the other three cases, one of them is going to play out, well, then put new money that's coming in, or money that's coming off of dividends and things, you reinvest into things like CDs, short term, a year or sooner, and just put that money to safety while you kind of wait for this all to play out. There are folks that are going right back to cash because they think that we're going to new lows. I don't think that's the case. I do not advise that, but for your own particular risk management or mental health, if you need to do that, then we'll do that, and we'll look at putting your money back to work later on. But that's a very challenging scenario. So overall, I thought I liked the article because the super smart economist is saying that we still most likely are going to have a soft landing, which is the best outcome out there.
Thank you, everyone, for your questions. Please submit your questions as a media or directly to our email at vipservices@ankerstarwealth.com. And don't forget to like and subscribe to get daily updates. That's all we have for today's show. I'm Allison Ankerstar. We'll see you back here tomorrow.